Welcome to the Utah Retirement System's webinar series. While this webinar has been pre-recorded, the information is still relevant. Please see the description below for links to the different sections within the video and other helpful information. We hope you find this webinar to be a useful resource in your retirement planning.
To the Tier 1 Public Safety and Firefighter Understanding Your Pension webinar. I'm excited to present the topics today, and as we get started here, we have our first question. We want to know how many years of service you have in the pension system, in the public safety and firefighter system. So I'll give you a few seconds to fill out that question. All right, looks like we have a pretty good mix on here. Plenty of people with quite a few years in the system. So I'm excited to present these topics. So today we're going to talk about replacing your retirement income. When you go to retire, you're going to have several different income sources. One being your pension, possibly Social Security, your savings plans such as 401ks, 457s, IRAs, and some of you may also have other income streams such as rental income or dividends or different other income streams. So today we're going to be discussing the pension part of the Tier 1 Public Safety and Firefighter pension. And we won't cover the other three income systems today. We want to go through, primarily want to go through the pension today. So our next question is, what is a pension? We'll throw this question up here and give you some choices here. So one is a pension and individual retirement savings plan, a lifetime monthly benefit based on your years of service and average salary. Is it a lump sum payment received by your beneficiaries after you pass away? Or is it a craving for Jell-O? All right, so a pension is a fixed monthly income for the rest of your life. So this is based on a formula determined by the years of service that you have as well as your salary. There are options to also provide a beneficiary part of your pension. So those of you that are married when you retired, you have the ability to not only have a pension for the rest of your life, but if something were to happen to you, then you may have the option to pass this pension on to your spouse's life, onto your spouse for the rest of their life. And then we're also going to talk a little bit about the cost of living increases. So the Tier 1 firefighter and public safety pension does have a cost of living built into the system. So when can you retire? What qualifies you to retire to be able to draw your pension? So the most important number here is the number 4. You can see that on the first line. If you have at least 4 years in the system, in the firefighter or Tier 1 firefighter or public safety system, you will qualify for a benefit. So if some of you only worked 4 or 5 years and never came back into the system, you could call us at age 65 and we would owe you a benefit and we would start paying you that benefit for the rest of your life. I want to look at the bottom line there. It says any age with at least 20 years of service. So once you hit 20 years of service in the Tier 1 Public Safety Firefighter pension system, you can start to draw your pension. It doesn't matter how old you are. You do qualify at 20 years of service. And then the one in the middle there is age 60 with at least 10 years of service. So maybe you started your career later in life, 50, 55, you work a few years, you get to age 60, and if you have at least 10 years of service, you can then draw your pension without any early age reduction on that pension. So how do you determine how much your benefit is going to be worth? This is the formula for both the firefighter and public safety pension system. to help determine how much your pension is going to be worth when you retire. So you can see the first line up there says years of service up to 20 years, and we times that by a multiplier of 2.5%. And then we take the average of your highest 3 years of salary. And then the second line says years of service after 20 years, we then use a 2% multiplier, and also we'll use your 3 highest years of salary. So and that is based on your base pay. So in the firefighter and public safety system, you will be benefited off your base pay. So overtime or any type of allowance does not count towards your pension benefit. But this would give you your maximum benefit here, this formula here. So let's look at an example. So in this example, we have someone that has worked 30 years, or 25 years. So we can see that the first 20 years, that we times that by 2.5%, that's going to give them 50% of their income. And they worked an additional 5 years after their 20 years, and we'll times that by the 2% multiplier, which gives us a 60% income replacement ratio there. So in this case, if their 3 highest years averaged out to be about $40,000, this would show them receiving an annual benefit of about $24,000 or $2,000 a month. So sometimes we hear some myths out there. Some people say, well, I know that I'm maxed out. I can only work 30 years, or I can only work 20 years in the public safety or firefighter system. That is not true. So you can work as many years in the public safety and firefighter system as you want, and each year you will continue to gain credit towards your pension. So let's look at this payout option. So going back to the example before, and this is split out into the top for the public safety payout, and at the bottom the firefighter payout. The public safety does have a couple options here. So if we look at the first option, we see that their basic monthly benefit would be $2,000 a month. And if something happened to them, their spouse would receive 65% of their benefit, so $1,300 a month. Now the public safety members, they do have an option to provide 75% of their pension to their spouse. And you can see just below the $2,000 a month, we see $1,971. So they take a little bit of a reduction in their benefit in order to be able to provide their spouse 75% of their benefit. So in this case, we see that there's about a $29 reduction a month, and now their spouse, if something were to happen to them, their spouse would receive $1,478 a month. With the firefighters, it's just an automatic 75% a month. So in the firefighter system, the member would receive the $2,000 a month, and then the spouse would receive 75% of that, or $1,500 a month. And again, these are just examples. Your pension, all of your pensions are going to be based on your salary, your years of service. Even with that reduction for the 75% payout in the public safety, this is all going to be based on your years of service and your salary. Another option you'll have when you go to retire is the partial lump sum option. There's what's called a partial lump sum option 12-month or a 24-month partial lump sum option. And the way this works is we basically look at your maximum basic payout. So in our case, our members were receiving $2,000 a month. That's what their pension came to. And in the 12-month partial lump sum option, we would times that by 12, which would equal $24,000. If they decided to take the 24-month partial lump sum option, they could take $48,000. What this is the ability to cash out some of your pension up front. You can take this lump sum amount up front, but in order to do that, you are going to have to take a reduction to your monthly benefit. So if we look in the first case scenario, if the member took in the public safety, if the member took the 12-month partial lump sum option and stuck with the 65% monthly benefit to the spouse, their monthly benefit would go from $2,000 a month to $1,868 a month, and that would be a permanent reduction. It doesn't go away after 12 months, which some assume that once they hit the 12-month mark, then that goes back up to their basic monthly amount. But this is a permanent reduction. If they opted for the 75% payout to their spouse, then their benefit would be $1,841 a month. And then on the 24-month benefit, basically works the same way, but because you're taking more money up front, there's going to be a larger permanent reduction on your monthly benefit. Now, some things to think about when you're looking at this partial lump sum option. People will often ask, does it make sense to take this? One thing we want to make sure everybody is aware of, that if you do take possession of this money, it is taxable. So if you go to retire and you say, okay, I want the 12-month partial lump sum, send me a check for that amount, whatever that amount may be. If you take possession of that, you are going to have to pay taxes on that, state and federal taxes, and that may also increase your other income taxes, because that may add additional income to your already earned income, and that could push you up into a higher tax bracket. So some things to think about there. Now, you do have some options. You can roll this into a 401k. So when you go to retire and you decide you wanted to take the 12-month or 24-month lump sum option, you could roll that into a 401k, and this does not avoid the tax, it just delays the tax. And in doing that, basically what you could do is say, oh, well, I only want to pull out maybe $5,000 this year, and you'd only be taxed on $5,000 instead of the whole partial lump sum amount. Some other things to think about whether or not you should take the partial lump sum is definitely you have to look at the permanent reduction you would take on your monthly benefit. But there may be some other reasons that you may be thinking of taking this. If someone was single and maybe their health was not very good, it might not be a bad idea to take that partial lump sum and enjoy that. If they know that they're not going to have a long lifespan, why not take some of that up front? Some other things to think about is if someone had a large amount of debt with a very high interest rate, this may make sense in their overall long-term retirement to pay off some of that debt if the interest rate was high enough to give them a better retirement. If you end up sitting down with one of our retirement advisors one-on-one, we can also run a break-even point for you. Some people will often ask, what if I take this money and I invest it? We can show you a break-even amount or show you how to calculate that yourself on what you would have to earn on that money to make up for that reduction that you're taking. And then one other thing to be aware of, if you are under age 50, there may be an early age reduction as well. So if let's say that you retired at 48 and you decided to take the 24-month partial lump sum option, so that would be $48,000 that would not only be state and federal taxable, but because you didn't qualify of being either age 50 working into age 50 or 59 and a half, then you may have a 10% early withdrawal penalty on that as well. So something to be aware of. And again, if you meet with one of the retirement planning advisors, we can go through that with you. So just a question here, how many of you think that you would take one of the partial lump sum options, either the 12-month or the 24-month partial lump sum option? We'll give you a few seconds to answer that. All right, it looks like the majority of you don't plan on taking the partial lump sum option. Some of you are not sure, and a few of you are planning on taking that. So we also have some online calculators that will help you to determine how much your monthly benefit would be worth. These calculators can show you a few different things. As we just talked about the partial lump sum, the calculator not only calculates your retirement benefit, but it will also help you calculate that break-even point for the partial lump sum and show you what your partial lump sum amounts would be. So simple way to access these calculators. You don't even have to log into your URS account. You just go to www.urs.org. And once you're on that page, right at the top of the screen, there's a calculator button. I know this is kind of small, but about right here, there's a calculator button. Once you click on that calculator button, you're going to have some options here. If you want to calculate your pension amount, then you would click on this retirement benefit estimate calculator. You'll go through a screen that will just basically say this is an estimate only, and then you'll be able to put in your information to help calculate your monthly pension benefit, your spousal benefit, the partial lump sum amounts, as well as that break-even point will show on those partial lump sum amounts as long as you put in a basically a mortality age or a life expectancy age on that. There are also calculators in there that you can calculate your 401k amounts, 457 amounts that you can access as well. So how do you increase your pension? Again, we talked about there's no limit to the amount of years that you can work. I think at times there's been myths that you can only work 20, 30 years. You can't go past that 20-year mark. That is not the case, or definitely no longer the case. You can work as many years as you want, and you would continue to get credit towards your pension for that. So one way to increase your pension amount is to work longer. Second, earn more money. Anytime that you have the ability for a promotion, raises, different things like that, that is definitely going to add to your pension. Again, this is always based on your base salary, but if you get a promotion or a raise, that's going to be included in your base salary. And then the other option is to purchase service. So public safety and firefighters do have a couple options to purchase service. So purchasing service credit, there's a couple different ways that in the Tier 1 public safety and firefighter can purchase service credit. There is not an option to buy your last 5 years or buy an additional 5 years, but some of you may have worked in a contributory system where you withdrew that those contributions. You can always buy those contributions back. You can always reinvest those contributions and get the credit for those years that maybe you withdrew that amount. And then the other option is to be able to purchase service for time served in other places. So for example, if any of you had active full-time U.S. military service, you could buy those years in the Utah system as well. You wouldn't even have to forfeit any benefit that you got with the military service. And then the other options would be if you had U.S. federal employment or private or Utah charter school employment, or maybe public service in a different state. So maybe you worked in Colorado or Nevada and you earned some type of retirement benefit there. You could forfeit those years and purchase those years into the Utah system and get additional years for that. Again, that's something that if you met with one of the retirement advisors, they could help you go through that and give you an estimate of what that would cost. Also, you can contact our pension department and they can give you the exact cost for that. So many people ask, what happens if I were to pass away before I drew my pension? And in both the public safety and the firefighter system, there are some active member death benefits. And these are split into a couple divisions as well as a couple different sections here. So the first one we're going to look at is Division A in the public safety pension. And all Division A means is that you currently work for a division that is paying into Social Security. So there are divisions in both firefighters and public safety that may not pay into Social Security, and we're going to talk about those benefits too. And then it's split into two different columns here. There's a line of duty death benefit, and then also in a not in the line of duty death benefit. So in the first section here, your spouse would get a payment equal to 6 months of your final average salary and a monthly benefit of 30% of your average salary. So if you had under 10 years of service or under 20 years of service. If you had 20 years or more, basically URS would consider you retired, and your spouse would get 65% of your retirement benefits. So basically they would get that spousal benefit for the rest of their life. And then if we look in the not in the line of duty options, if you have less than 10 years of service, your beneficiary would get a $1,000 lump sum or a refund of any contributions you made. So some of you may be in a contributory pension where you are contributing to that. If something happened to you under 10 years, then those contributions that you made would be paid to your beneficiary. If you had 10 years of or more of service, your spouse would get a $500 lump sum and a monthly benefit of 2% of your final average salary for every year of service up to 30%. So for every year you had, basically we would times that by 2 up to 30%, and your spouse would get a lifetime benefit. And again, if you had 20 or more years of service, we would consider you retired, and you would receive 65% of your spouse would receive 65% of your retirement benefits. So Division B is similar, but there are some differences there. This would be for anybody that's in a system that is not paying Social Security, in public safety, not paying Social Security. And this would be similar. Your spouse would get a payment equal to 6 months of your final average salary and a monthly benefit, and this is the difference here, is that instead of 30%, it would be 37.5% of your final average salary, taking into account they may not receive any Social Security benefits. There are also some benefits for your dependent children, which would be $50 per month if you have at least 2 years of service. And then if you did have 20 years or more, we would assume you were retired and your spouse would get that 65% benefit. For those if something happened not in the line of duty, you would get a refund of any contributions you made and 50% of the last 12 months salary. 2 years or more of service, you would get your spouse would get a $1,500 lump sum and a monthly benefit of 37.5% of final average salary, and your dependent children would get $50 per month. And if you had the 20 years or more, then basically again we would consider you retired and your spouse would get that 65%. So with the firefighters, very similar on the Division A, those that are in a system that pays Social Security. If you had 20 years of service, less than 20 years, a payment, and this is in the line of duty, 6 months of your final average salary plus 30% of your final average salary. And then really the only difference here is if you had at least 20 years of service, your spouse would get the 75% of your retirement benefits. Very similar to the public safety over here. Again, the only difference being if you had 20 years or more of service, your spouse would get the 75% of your retirement benefit. And then Division B, that's those that firefighters that are in a system that does not pay into Social Security. Again, that benefit jumps up to, and this is in the line of duty benefits, 37.5% of your final average salary as opposed to 30%. Your dependent children would get $75 per month instead of 50, and your spouse would get 75% of your retirement benefits if you had 20 or more years of service. Less than 5 years of service, we would refund all of the contributions, and your spouse or your beneficiary would get 50% of your last 12 months salary. And then if you had 5 years more of service, and it would be similar as the line of duty, where you would receive that 37.5% payout on that as well. So steps to retirement. Let's find out how many years people have until they retire. So we got our next question here. So how many years until you retire? 0 to 2, 3 to 5, 6 to 10, or 10 or plus more years. Right, it looks like the majority of those on the webinar today are fairly close to retirement. So let's go through the steps to retire. So if you are between 2 and 3 years before you plan to retire, we would recommend that you request a pension benefit estimate from our pension department. So basically you would just call them up, tell them 1 or 2 dates when you're planning on retiring. So maybe somebody wants to see what it would be if they went a year longer. This would help them get an idea of what their pension would be worth. And then with your retirement dates, with us, you can retire on the 1st or the 16th of any month. So just make sure if you want to retire on the 1st that you do not work on the 1st. Make your termination day before the 1st. If you do work on the 1st, then that's going to push you to the 16th for your retirement date. Same with the 16th. Don't work on the 16th. Just make sure that your retirement date, your termination date is before the 16th. At the bottom of the screen, you'll see a couple phone numbers there. There's the 800 number or just the local number. This is the phone number for our pension department. If someone does want to call and get a pension estimate, this would be the numbers that you would call on that. So 2 to 3 months prior to retiring. So 90 days is the soonest that you can apply for your retirement benefits with URS. Now, your individual employers may have some different requirements, but to apply for your pension, it would be up to 90 days before you retire. And you have two choices. Again, you can call the pension department and you can make an appointment with them and you can fill out the retirement packet with them. There's about 6 different forms. These forms are just going to go over what option you want, whether or not you want to do the partial lump sum, how you want your taxes withheld, and so on. Or you can just request the packet yourself. They'll mail you out the packet. You can fill out the packet and you can mail that back in, and that starts the retirement application process. I would recommend, if you do have the time, to definitely make an appointment with the pension department. Sit down with them for 15-20 minutes, fill out that paperwork, and then you know when you leave the building that your paperwork is complete. But if you don't have that option, requesting the packet and filling it out yourself is not a hard deal either. So materials that you need to have available to retire. So when you go to retire and you fill out that application, that retirement application, you're going to need a copy of both yours and your spouse's birth certificate if you're planning on leaving a spousal benefit. This does not have to be the original birth certificate, just a good copy of yours and your spouse's birth certificate. You will also need a copy of your marriage certificate. Again, it doesn't have to be the original, just a good copy of the marriage certificate. And then a copy of a voided check, and this is so you can do the direct deposit for your pension. If you do have them mail you a check each month, then they do take $20 out of each check, so I highly recommend that you do the direct deposit for your pension. So a couple of the forms. Number one is the retirement application form. These are forms that are included in that packet. The retirement application form is where you'll choose the option, and this is really more for public safety. They have the option to do 65 or 75% to their spouse, where the firefighters is just automatically 75% to their spouse. The W-4, this is where you'll say how much tax that you want withheld. So the pension is both state and federal taxable, unless you are going to reside in a state that does not have state income tax. If you stay in Utah, you will pay state and federal tax. This is not a permanent election, so at any time you can always change your tax withholding. So 1 year after you retire, you do your taxes and you felt like they withheld too much, you can always change that. Or if you felt like they didn't withhold enough, you can always change that. Beneficiary form, and also the direct deposit form, and that's what that voided check is for. So a couple things to consider. Your pension payment. So your first check may take up to 90 days to arrive. So be prepared for this. So for example, if you retired on January 1st, you may not receive your first check until April 1st. However, that will be a retroactive check, which means that if your retirement date is January 1st and you don't receive your first check until April 1st, that first check will include January, February, March, and April's payments. So that first check will be quite large, and then going forward, you will receive your pension check once a month. And this is deposited in your account usually on the last business day of each month, so you'll see that in your account generally the first business day of each month. Cost of living adjustments. So 1 year after you retire, URS will look back on your anniversary date. They'll look back on the consumer price index to gauge inflation, and you will receive a cost of living adjustment on that inflation index up to 2.5%. So some employers have elected to be a 4% COLA. So this is all for the firefighters. This is all dependent on your employer, so you may want to check with your employer to see what the cost of living adjustment is for that. But everyone will have at least up to a 2.5% COLA. Just to kind of show you how this works, explain how this works, is let's say that 1 year after you retire, inflation was 2.2. You would receive an increase on your base pension amount of 2.2. Now, you would never lose that benefit. So let's say, for example, the next year that inflation was 3.5%. So for that year, you would get a cost of living adjustment of 2.5%. They would put that additional 1% in a bucket, and let's say the following year, maybe inflation was only 1.5%. They would then pull that 1% out of that bucket and add that to it. So even if inflation is over the 2.5% or 4%, if you're in a system that has 4%, which all firefighters are, you would never lose that above that. They would just bank that in years that it was below the 4 or the 2.5%. They would then add that to your cost of living adjustment. Here's just an example of what the cost of living adjustment history has been. So last year we had about a 2.4% increase. We can see back in 2015, inflation was very low. There wasn't much of an increase, but definitely there was a little bit of an increase. So a couple things to consider is taxes. Like I mentioned before, the pension is subject to federal and state income taxes. Unless you plan on residing in a state that does not pay state income tax, you would be exempt from those state income taxes. You can change your withholdings on the W-4 at any time. And each year, at the end of the year, you'll receive a 1099-R to file with your income taxes. And this is just basically a form that says how much income you received from your pension for the year. Okay, our next question. Pull this up here. So, true or false? After I retire, I can return to work in the public. Sorry, let me start over here. True or false? After I retire, I can return to work with a public employer in Utah. And just to be aware, there may be more than one right answer here, but let's go through these. True, I can return to work immediately. True, I can return to work full-time with benefits after 60 days. True, I can return to work part-time after 60 days with no benefits. True, I can return to work after 1 year full-time with benefits. Or false, I can never return to work as a public employee in Utah. All right, looks like we have most of our answers in, and most people are saying true, I can return to work after 1 year full-time with benefits. So let's go through these options here. So if you go back to work for a URS employer, it doesn't matter if it's a school district, a city, state, county. If you go back to work after you retire, within 60 days, they basically will cancel your pension check and you'll be put back in the system. You'll basically earn, it will be like you never left. You'll earn additional service credit if you're eligible, and you would have to stay for at least 2 years to be vested. So let's say after 30 days you decide to go back to work for a URS employer and you only worked a year and a half, you would not get that additional service credit. You would have to work at least 2 years to earn that service credit. And then once you retired, again, you would then start to receive your previous pension plus any additional years of service you may have accrued in that. So the second option is you go back to work for a URS employer after 60 days, but within 12 months. So in this option, you can go back to work for a URS employer after 60 days and before a year and continue to draw your retirement check. However, there are some caveats to that. So number one, you could not receive any benefits. So no health insurance, no vacation days. You could not work in a benefited position. And also, you would have to make less than $16,743 a year. Or if half of your final average salary was less than that, you would earn the lesser of the two. If you did go over the 16.7, if you made more money than that working for a URS employer, you may be on the hook to have to pay back some of your pension money. So just be aware of that. A couple things to be aware of is, some people may say, well, I'm going to retire and I'm going to go work for the local golf course. I'm just going to be the marshal on the course. This would possibly be a URS employer if it was a city or county golf course. So a couple things, just make sure that if you do go back to work that if it's for a URS employer, that if it's between 60 days and 12 months, that you understand that you can't make more than the 16,743 and you cannot earn benefits. You also would not earn any more service towards your pension. Now, one thing to be aware of is some people think that if you go to work, day 61, as long as I make it to my 1 year mark from when I retired, then I can start getting benefits and I can make as much as I want. That's not the case. You would have to stay out a whole complete year. So if you went back to work day 61, worked until your 1 year anniversary, you would then have to quit and stay out a year if you wanted to get the benefits of staying out a year. It would start the clock over. And that gets us to our 1 year mark. So this is probably the most popular option, is you stay out of the URS system for a full year, and then you could go back to work for any URS employer and you could receive benefits, so health insurance, vacation, sick time, and you could continue to receive your pension. There would be no restrictions on that pension, and there would be no restrictions on the amount of income that you could earn. The other option that you have in that situation is you could voluntarily cancel your retirement check, go back into the system, so you cancel your pension, you go back into the system, and you start to accrue new service years. For most, this is probably not going to make sense because you'd probably make more drawing your pension and working, but maybe in a few scenarios it may make sense to cancel your retirement check, earn new service, and then draw your pension once you fully retire. One other thing to consider is because you're in the public safety and firefighter system, you do have an additional benefit where you may be able to use up to $3,000 of your pension payments each year to pay your insurance premiums. So if you're going to go out into the market and purchase insurance, and we know this is the case for a lot of firefighters, police officers, they retire early and they have to find some insurance somewhere. The IRS does allow you to use up to $3,000 of your pension money tax-free to be able to buy a couple different insurances there. Health insurance, long-term care insurance, or accidental insurance. This is something that you would want to talk with our pension department about, because the plan that you purchase would have to qualify for this, but the pension department, maybe possibly PEHP, could help you with this, that if you purchased a plan that you could use $3,000 of your pension payments tax-free to purchase premiums for health insurance or these other qualifying insurances. So how is your pie proportion? So what part of your income replacement is going to be your pension? So in our example, we had someone that had a final average salary of $40,000. They had 25 years of service. They're going to retire at age 62. Their spouse is 60. So their pension is going to replace about 60% of their current income. So for them, they're going to have to figure out how to fill the other 40%, but this is a pretty great benefit to be able to replace 60% of your income with just one single income source. And that concludes our webinar today.